Time for your call sheet. Crew members today: Peter Boockvar, Ryan Dietrich, Gilbert Garcia. Okay, we're rapid fire here today. I don't know how we got crunched up against the end of the show, but we did. But we're going to get it all in. Peter, want to get your thoughts on what we've seen with the Treasury this week?
So Scott Bessent clearly drew a line in the sand. I think a few of his challenges is the market is much bigger than he is. He does not have a printing press like the Fed. I think that the trade-offs are he's buying debt probably at well below par, which is a positive, but he's giving up low interest rate debt by doing so because the bonds he's buying back were when rates were at zero, and he's replacing it with short-term bonds that have much higher interest rates. So this is a dangerous game that's being played here. I understand his frustration with the rise in the long end. We also have to watch the U.S. dollar, because if we lose the U.S. dollar over this, well, that's inflationary, and foreigners own a lot of U.S. assets, and a weaker dollar could facilitate their selling of U.S. assets. So this is a game of whack-a-mole.
Okay. And we have seen the dollar weaken this week. Gilbert, I think we've tracked you down on your world travels just to have you weigh in, so there's no one better I want to hear from right now.
Thank you so much for having me. First of all, I think it was a brilliant move. And I take a little bit of the other side of the trade. I think what the Secretary is saying is that the fundamentals do not warrant as high rates as they are today. And if you look since the war, the majority of interest rate increases have come from real rates. And of course, we all know that real rates being higher are much more difficult than just nominal rates being higher. Of course, when nominal rates are higher, we know that that's inflationary. There must be some inflationary pressures. That probably means wages are going up. That probably means businesses have the ability to raise prices. But when real rates go up, it's a much more strangling effect of the economy, and that's what they're trying to curtail.
Ryan, I want you to weigh in on this, especially since you've been on panels with me here on this show in the last couple of weeks where we said, you know, when does the stock market start to listen to the bond market? It seems like that's happening now.
It does. Good morning, and thanks for having me back. I mean, listen, the last 5 days, S&P is down 2%. We know we've had some weakness. Like we said, Jackson Hole is next week, NVIDIA earnings next week. To have a little indigestion with the markets, not surprising. That 10-year yield's up around that 470, 480 level. I know Frank Capillari comes on with you. He's mentioned that level for like 2 years has been kind of the peak. So we're not breaking out yet, but clearly those concerns are there with those higher yields.
Yeah, we've seen a big move higher in gold. Bitcoin is having a move this week as well. To Ryan's point, Peter, we're looking at the Fed with Jackson Hole next week, and certainly questions about what that's going to look like in the messaging there now. NVIDIA, possible we get an Anthropic prospectus drop here too, and then PCE.
Well, with Warsh, he's told us he's not giving us forward guidance, so I don't know if we're going to learn anything new. Of course, I do want to hear what he has to say about what Bessent's doing, because by Bessent front-loading short-term T-bill issuance, Fed policy is then highly influential on the amount of interest expense we're going to pay if he's going to do that. I think with Anthropic, it would be great to see them IPO. They need the capital, but that's extra supply on the market after the SpaceX. And the other thing you said was?
Oh, PCE inflation.
PCE, of course.
Yeah.
Well, with interest rates doing what they're doing, that's going to be huge. Now, the one thing with PCE is because we've already seen CPI and PPI, it's usual that PCE doesn't really deviate much from expectations. But getting back to what our other guest said, I do think it was smart to try to cap long rates, but that's a big fight. The market is much bigger than Scott Bessent. Scott Bessent does not have a printing press like the Fed. So just because you do something, that doesn't mean it works. And I see this more like FX intervention, where unless you have policy change, these effects tend to be very fleeting.
Yeah, which we've gotten with dollar-yen as well in recent weeks, too. Gilbert, your thoughts?
I think this is just the very first salvo. I think with time, we're going to see if it doesn't work, they're going to keep going. They're going to keep going. It's going to be something as large as some type of Operation Twist, because I know that, or at least I believe, that they want to get real rates down. I think it's a coordinated effort by both the Treasury and the Federal Reserve. I think the Federal Reserve is going to be waiting for those task forces to come out before they raise rates. And I think these are coordinated actions to get rates lower.